Good morning to you, and there's so much to talk about. Really, you start with the economic news, Derek, that we saw this week. Earlier in the week, we saw the Federal Reserve come out with some minutes, and that, of course, spooked the market. And then later in the week on Friday, we saw an unemployment report.
Right. The jobs report actually was better than it first appeared. I mean, we came in at 199,000 jobs in December. The analysts had estimated 422. But when you add back revisions, it ended up being about 340,000. So a little bit below expectations. But the really good news for the United States was that civilian employment was up 651,000 in December, which helped push the unemployment rate down to 3.9%, which is one of the lowest readings we've had in 50 years.
It's not only that, it's certainly slower than what we've seen since the pandemic started. So people are still slowly getting back to work. Those people who want to stay out of work still are staying out of work. So there's still a number of job openings. One of the parts of the report that I thought was very interesting was average hourly earnings up 5% year over year. That really is a harbinger.
Right. And when you combine hourly pay and the number of hours worked, total worker pay has increased 9.9% in the last year and is up 8.5% since February 2020. So ahead of the rate of inflation, which some people have been concerned about.
And so one of those things that we have to pay attention to, obviously, is how the Federal Reserve acts or reacts, more importantly, to this information. We do know that the Federal Reserve has two jobs. One is price control, and the second, of course, is trying to keep us fully employed. That's the dual mandate. It looks like the first piece, the part of the unemployment numbers being where they want them, is there, because they usually say 4 to 5% is fully employed in this country, 3.9% and going lower. You would have to think that they're going to change their focus all out to price control.
Well, and the odds makers would agree. Right now, the betting odds are 60% will see the first rate hike in March, 80% the first rate hike in May. So we're clearly on the way to a couple of higher rates. But that's going to be data dependent. It always is. And the Fed has had a way of backtracking in the face of data.
And so they do look backwards, right? When you're driving on the road, generally you'll look forward through the windshield. It appears to me that the Federal Reserve is looking backwards, and that could lead possibly to a Fed mistake. And what I mean by that is obviously they were pouring trillions of dollars into the market when it appeared by some that we didn't need that. And now as we're heading into a potential mid-year election or potential geopolitical issues, they'll be putting on the brakes.
Right, and that's the danger. You see slowing growth and higher interest rates. I mean, we did see some other numbers this week that were lower than prior reports, but still solid. We saw the non-manufacturing index was at 62, still expansionary. The manufacturing ISM was weaker than expected as well. But the other thing we saw in that was that prices paid dropped at the fastest rate since 2012, and that's what people have been concerned about, these sharp increases in goods prices to the expense of the service side. So the inflationary pressures are starting to abate on the goods side. The question is, when will they start to abate on the services side?
And one of the things that you have to pay attention to, obviously, is what the Fed does in the economy, because it is directionally connected to the stock market. In 30 seconds or so, Derek, where do we think interest rates are going to be by mid-year?
Well, I think we're going to see two rate hikes this year at a minimum, perhaps a third. That's what the market's expecting. And some more bearish forecasters are actually thinking 4 hikes because they believe that the Fed is going to be extremely hawkish. I believe Powell is a much more moderate thinker than that. And also, they're going to be appointing some new appointees to the FOMC from the Biden administration. I'm assuming they're going to be doves, so they're not going to be out to tank the economy anytime soon.